Hello everyone and welcome back to the Velocity channel where this is your bridge to financial freedom. Listen, you and I both know that we were not taught velocity banking growing up, which is actually the source of many of our debt problems that we have today. But today I'm going to show you how to implement velocity banking for yourself from start to finish, okay? Of course, we're gonna go ahead and get rid of those cash flow sucking car loans, those auto loans. Many times they are cash flow sucking. We wanna get into the nitty gritty right after this. Folks, please like, share, and subscribe so that everyone around the world can know the power of doing banking the non-banking velocity banking way. God bless you. Now listen, I want you to know that the line of credit is not your enemy. Let me say that just number one. It's not your enemy. Just like fire is not your enemy. Can you get burned with fire? Of course. Can the line of credit burn you? Of course. But only if you don't know how to use it. Let's find out how to use it, shall we? So as always, let's go ahead and go an overview of what we're going to eliminate. We're going to eliminate this $25,000 auto loan at 10%. It's $531 a month, okay? We have a line of credit of $10,000 at 21%. It's letting us know that $500 each and every month is going to be what is assigned to us to get down that $10,000. Now, if you pay that way, the bank's way, you're not going to be finished with that $10,000 for years. But going the velocity banking way, we want to show you out of this much quicker than that. Now, let's say you get paid $5,000 each and every month, which is the national average, all right? $60,000 each and every year. But you are left with a cash flow of zero every month. Why? Because you are segregating your income to groceries, to mortgage, to auto loan, to credit cards, and they told you put your money in IRAs and savings accounts and let it stack up and accumulate while inflation is ripping that value down. We want to stop the madness, don't we? We want to stop the madness. We want to sit back and we want to say, how can I use my money more wisely? And this is how. We're going to use that $5,000 to increase our cash flow. Because as our cash flow increases, our debts decrease, and that's rapidly. So instead of segregating this $5,000 like they want us to, let's go ahead and make sure we consolidate, right, inside of our line of credit. So that is going to mean that this balance is going down $5,000, all right? So when we use our line of credit like that, do we have to worry about that minimum monthly payment? No, we don't. Matter of fact, we can go ahead and transfer that $500 a month down here to our cash flow. All because we are utilizing our finances correctly, all right? Actually, let's do this. Okay, let's do this. Let's say you had $750 inside one savings account and another savings account you had $750 in, right? And you would allocate to that every month. Instead of doing that, why not add that amount to your cash flow to pay it down, okay? So what is this, 1,500? 1,500 plus 500 is 2,000. Now, we take that $2,000 and we say this, that's the cash flow. And that is gonna help us pay off this line of credit rapidly, not years, but months. So let's go ahead and take that balance of $10,000, okay? And what are we going to do? We're going to divide it, right? Because the line of credit, right, the line balance divided by the cash flow is going to equal our velocity term. That is, how long is it going to pay off that line of credit? And it's only going to take 5 months. Why? Because 10 divided by 2 is 5 months. Okay? Do we see how we went from zero to $2,000 in cash flow. Now you can use your numbers. I use people's numbers all the time. We're helping people to eliminate debt simply by using what they already have. Now, let's go ahead and graduate. Since we went ahead, 5 months passed, now we got the $10,000 back. We don't have to segregate our income like we did incorrectly. Now we have $2,000 in cash flow and we know what to do with it. Let's hammer that loan, shall we? Okay, we go to the dealership. We say, yep, I want to put down $10,000, not as a down payment. Now you can if you want, right? But you want to say, I want to put $10,000 towards this principal amount. Because right now, the 10% is eating on what? The 25K, right? But what if that amount was smaller? Because you see, the bigger this amount is, the bigger the principal amount, the bigger the interest, right? And we don't want interest. We want to cancel interest, all right? So let me know if you want any help with that. I'm an interest cancellation specialist. Because $10,000, if we subtract that from 25K, it's going to leave us with 15K. And so that is what the 10% is going to eat on right now. Now, how long is it going to take us? How long is it going to take us to replenish that $10,000? Because we do have to replenish it, don't we? Remember, it's going to take us 5 months. So another 5 months goes by, and of course we're paying the $531 a month. We got it in our budget. We got it in our map, in our money allocation plan. We can do it, all right? But when that 5-month mark hits, what are we going to do? Man, we're going to hammer it again. And so whatever the balance is then, it will be $10,000 less. So let's say the balance was like 15,000, right? For easy math. And I know you're paying it down each month, but for easy math, we'll just say 15,000. 10,000, boom. So 15 minus 10 is what? 5,000. How long did that take you? 15 months? And they want you in this car for 60 months? Why? Why couldn't they have shown you that? Because this number right here, that's not going to the principal. It's going to the principal and the interest. Meaning they're going to divide this number up. And many times it's going to the interest, especially the higher the interest rate, it's going more to the interest than it is to the principal. And so it kind of looks something like this. Okay, do you see that? It's split up. The interest, 208, principal, 323, and then the balance is going to be the 24,676. That's actually how they split up this payment, okay? Do you see how much is going to the interest? Okay? And actually, it's because, in large part, because of that interest rate. If the interest rate was down, you'd actually see that number go down, all right? But at the very beginning, yes, you do have to pay a little bit more to interest, but then you have the principal. Look at how much is going to the principal. And so you'll realize that the higher this number goes, the less goes to principal, the more goes to interest. So we would like a lower interest rate, but guess how many months you're going to be in this loan? You're not going to be in the loan for that many months. You're not going to be in this loan for 60 months, 72 months, 84 months. I just showed you how to get out in 15, 20 months, okay? And so this is how you want to move your finances in a way that is good for you versus the banks. Now, if you have any questions on how to move the money, perhaps you need to have a conversation with us, or perhaps you need to get the class, go ahead and do that, because we're making sure that people get out of debt as soon as possible. I don't know if you've known this, but there's some volatility going on right now, and it's just going to be something that we want to make sure that we are prepared for, right? So that we float on top of the water instead of being underwater, all right? Folks, thank you so much for your time. We're going to go ahead and continue on with this line because we got to get you out of this segregation method, all right? Remember, it's segregation many times is bad, especially for your income. God bless you, and we'll see you soon.